Hey everybody, welcome to week 3 in RMI 670. I just wanted to talk about a couple of things that are going on right now that I think are really interesting. First thing, week 3, that's where we're going to be talking about insurance as a risk management technique. So sometimes insurance makes perfect sense, and we're going to talk about when in the lecture. Well, really last lecture is kind of where we left off. Right at the very beginning of this lecture is where we're going to talk about when do we want to use insurance. And in general, we want to use insurance where frequency is low, severity is high. That's where insurance works best because that's what makes it cheap, right? The idea that my house could completely burn down with everything in it, that's extremely unlikely. That's a good thing. But because it's unlikely, it makes it possible for me to afford to use insurance as a risk management technique. If half of my neighbors are going to suffer a loss this year from their houses burning down, we're going to find out that it's going to be really hard to raise money through the insurance mechanism to be able to pay for the losses. In fact, financially, I don't think you could do it. So we're going to talk about the situations where that makes sense. And this is really relevant. Right now, we have a big debate in healthcare. Think about the losses that we have in healthcare. Everybody has losses every year from healthcare, virtually everybody, right? It's rare to find somebody that didn't have any medical expenses at all for an entire year. Sure, some people are young, some people are healthy. That's going to change. And when you look at the population, most people have medical expenses. So the idea that insurance is going to be the way we deal with everyday medical expenses, that should immediately spark something that says, wait a minute, that doesn't sound right. And in fact, we're kind of seeing some evidence of that. Catastrophic health expenses might be able to be financed by a pure insurance mechanism, but everyday health expenses, now we're just inflating it. This is all going to be talked about in this lecture and later ones when we talk about healthcare. But the basic idea is, look, if I have $100 medical expense, that isn't a life-changing expense. The severity is not high. Sure, I'd rather have the $100. And I'm not saying that that's easy for anybody to pay, but it's not going to change your life. If you had to finance that, you could do it. It's not like my house burning down. Right? That's a very different risk in terms of severity. But somehow we got this idea that every healthcare expense should be paid for through insurance, and all that does is inflate the cost. Because by the time we adjust a $100 claim, we might have to pay somebody $100 to do that. So now you got $100 going to the provider, $100 go through the adjustment process. You've just spent $200 on a $100 expense. System-wide, that's not efficient, right? So some expenses make sense to finance through insurance and some don't. And the lower the frequency, the better off we are. When it's something that doesn't happen very often, term life insurance is extremely affordable because people dying within 30 years of age 20 or 25 is extremely rare. We might all know people who that's happened to. But by and large, as a societal phenomenon, that's rare, and it makes term life insurance very inexpensive. Okay, didn't want to get too far off of what I wanted to talk about today, which is GameStop. What's going on with GameStop? You say, well, I hope you've kind of been following this. If you're somebody who's at all interested in business, this is a fascinating story, what's been going on. So I just pulled up here on my screen. I've got GameStop here because it's the best way to show people what's been going on. This is Friday afternoon right now, right around 2:15. Here's the price of a share of GameStop, $258. Well, that doesn't mean anything until you look where it was trading 6 months ago. So let's look at that. So 6 months ago, I was trading at about $11 a share, 11, 12, 13. You see the value changing here. I'm pointing. You can't see what I'm pointing at. The part that's in the black arrow is the pricing and how that's changing. So it was consistently every 6 months ago at 12, 13, $14 a share. And then all of a sudden, something starts happening. And this is really within the last couple weeks. How all of a sudden does a stock that's been consistently trading at $11, $12, $13 a share, how does that go to $259 a share? What's going on? Here's what's going on. It's psychology is the most interesting thing. So when we think of the stock market, we say that really the value of the stock is what we expect future dividends to be, the present value of future dividends. That's one of the valuation models that we talk about. And that pretty clearly doesn't make a whole lot of sense in this particular case, right? What is GameStop? They're a retailer. They sell gaming systems. They buy and sell, I guess, and they'll sometimes make money on the spread there, and they're selling new items as well. But it's a brick and mortar business in a business that is increasingly moving online. That's a risk. All of a sudden, there's no reason for it to be valued at 20 times what it was valued at 2 weeks ago. Just as a business valuation, there is nothing that explains that. Here's what explains it. Here's what's going on. So somebody noticed that there was a huge amount of short interest in GameStop. Short interest. Okay, these are people who are buying the rights to, well, in some cases, the rights to, if they're buying options, and others are actually short selling. So what they're doing is they're borrowing the share, they're selling it, and then they're hoping to buy it back later at a lower price. So when you go short, what you're hoping is that the price goes down and you're going to profit from that. I hope, I'm guessing most people in here, that's a review. I don't need to go too far into that. So a lot of people are short on this. And somebody noticed that and they said, well, what if I could inspire a whole lot of people to buy and push the stock price up? Well, as that stock price goes up, the people who are short have to cover. They have to buy, which further increases the price. And we've been watching this play out between the big hedge funds that had shorted GameStop and then somebody who recruited basically an online group. I don't want to call them a mob, but online like-minded people to say, let's focus in on this one stock and combine all our buying power to try to force the price up, force people to cover these shorts. And in theory, the price could go on forever. Now, fundamentally, this doesn't make any sense, right? If you're looking at profits, I'm a big believer in, this is an opinion, you talk to who you want here, but I'm a big believer in, I don't want to buy into a company that isn't making a profit. Well, they're not making a profit and they haven't for a long time. It's one of the reasons that the hedge funds had shorted GameStop. But to watch this play out has just been amazing. And we haven't seen how it's going to end yet. You got two sides, one that's bent on we're going to buy as much as we can, and the other side saying we're just going to keep accumulating enough capital to fund our margin positions so that we don't have to sell, and we're going to try to force this price back down. Normally, when you have a battle like that, whoever has the most money is going to win. So if I had to predict, I'd say it's going to be hard for the individual retail investors. Those are the ones who've been buying, trying to force this up. It's hard for me to believe that they could end up on the winning side of this. And we saw a little bit of this yesterday when one of the big retail platforms, Robinhood, decided to stop allowing this particular stock to trade. So all of a sudden you say, well, I want to buy, I want to sell, and they yank the rug out and they say, well, you can't. We're not going to allow you to buy, to continue, but they were still allowing people to sell, which is raising huge questions, as it should, about whether or not the playing field is fair. It's certainly not level. It would be hard to argue that it's been level. I don't want to get too far into the field of opinion, but I think that's at least fair to say that it would be hard to argue that the retail investor has been on the same plane as the hedge funds. So anyway, watching this all play out has been fantastic. I didn't mean to go so far into it from an academic perspective. I don't have any money on this. And as a risk management person, you can probably imagine what my thought is. The idea of unlimited losses, which is what you face when you short sell, theoretically unlimited losses because the price, there's no upside limit. So when you sell, there's no limit to your losses. Conversely, when you buy, there's no limit to your gains, potentially, because there's no theoretical upside limit to a stock price, right? And it's just the inverse of each other. Anyway, I didn't mean to get too far, but I did want to mention it because it's so fascinating. One last thing. I got a chance, this is a long time ago now, but I did get a chance to meet Warren Buffett in a group of about 40 other people. And my question to him, I'm not going to claim I predicted this, but my question to him, this was 2004, I think it was. And at the time, the markets were doing well. And Buffett's big thing, we'll talk a little bit more about Buffett in a couple lectures from now, but his big thing is he likes to buy $1 worth of value for 40 cents, right? So he sees value and he wants to get in on the low side and then hold it forever. So I asked him about the inverse. I said, well, if the markets are doing well right now, why don't you do the opposite? Couldn't you make just as much money by looking at companies and saying this company is clearly overvalued? I'm gonna short and hold. And what he said is now coming true. He didn't predict this. What he said is, I don't like the idea of being forced to potentially commit unlimited amounts of money to back up a position. And this is exactly what's happening now. So he didn't specifically predict this, but this is exactly what he was talking about when I talked to him 20 years ago. Now, I remember this. I like to think he's going around saying, well, I remember when I met Kevin Gatzliff and he asked me this question that's playing out right now. Pretty sure that's not what's going on. But man, I'll never forget it now. I didn't quite understand why he was so reluctant then, but I believe it now because I'm seeing it play out. Anyway, like I said, didn't want to get too far down that line. Expectations for this week. There's a discussion asking you about your experiences with insurance specifically. I'm liking how the discussions are going because this class is a little bit smaller than it has been in the past. So that allows me to get a little bit more in depth in the discussions. When you got 40 discussions, it's really hard to give meaningful extrapolation and to actually build, different perspectives when you got that much going on. It's hard. So I did want to mention that we've got a discussion about insurance. We've got an article to read and a quiz to take. And then it's chapter 2 in the text about insurance and the actual video lecture that, again, is going to be close to 2 hours. But by the time you account for the break, it's closer to 1.5. Anyway, doing what I can to try to minimize the time expectations, going for quality over quantity this time, and I hope it pays off. So that's enough time to take on the intro. We'll go from there. If you got questions, you can always email me, and I always appreciate hearing from you. So keep up the good work. Let's keep going. Thanks, everybody.